Hello and welcome to the second video in our 9-part series on the accounting cycle. This video is going to focus entirely on transaction analysis. As you saw in the introduction, when you do transaction analysis, the first thing you need to do is to identify the affected accounts in a transaction. Then you need to journalize that transaction and post the transaction to a general ledger. And I'm going to walk you through all the steps that are going to get you to the very end point where you can post it to your ledger. The first thing you need to understand is what is the basic accounting equation. Assets is equal to your liabilities plus your owner's equity. What that means is the assets are the things that you own. Your liabilities are the things you owe, your debts. And owner's equity is your net worth. So in other words, the things you own has to equal all the things you owe and your net worth. That's the accounting equation, and it must remain in balance all the time. The next thing we do is look at what are the accounts that are affected in a transaction. Every transaction has two accounts as a minimum. Sometimes there's more, but there always has to be two. So here's an example. Let's say that investors provide $10,000 to start company X. What are the affected accounts? The first one is cash. They gave you $10,000, so cash goes up by $10,000 for the company. The company also now has shareholders. So we have an account called owner's equity, and owner's equity is increased by that same $10,000. Now, the next thing we move on to is the general journal. Every transaction you have is recorded in a journal. So those accounts we just identified a moment ago, we have to put that information somewhere. So that journal will include the date of the transaction, the names of the accounts that were affected, the amounts, and then a short description of the transaction so that when someone looks back in time, they'll understand it for audit purposes what exactly happened in this transaction. This is what a general journal looks like. You can see it's just a bunch of columns and rows. So we go back to our original example of the investors giving $10,000 to start the company. We said the affected accounts were cash and owner's equity. You'll notice in the general journal, the debit accounts were listed first. So in this case, it was cash, and the second account was owner's equity, and that's a credit. And I'll explain that in a moment, why it's a debit and a credit. And what you can see is all the information that goes into journalizing that transaction. First, the date, then the accounts, the reference, I'll explain that in a little bit, and then this debit and credit and the two amounts. So what is this whole thing about debits and credits? Well, in accounting, debit means left side, credit means right side. When you think back to that accounting equation of assets equals liabilities plus owner's equity, everything on the left of the equal sign, those accounts typically have a debit balance. Everything on the right-hand side typically has a credit balance. So when we say left side and right side, we're talking left and right side of that equal sign. So a quick way to remember that is your debits are anything that's an asset typically has a debit balance. Your credits are going to be your liabilities and your owner's equity. And then when you go to our other video, when we look at your income statement or your statement of comprehensive income, your revenues are going to be credits because they increase owner's equity, and your expenses are going to be debits because they decrease owner's equity. Now we need to post this transaction to our ledger. A ledger is just simply a file folder where you keep all the transactions for every account. So each account has its own ledger. In this case here, you can see the opening balance for our cash was $0. Then on January the 1st, the owners invested that $10,000. So the company's cash balance went up by $10,000. On January the 5th, they did something, I'm not sure what that transaction was, that reduced the balance in the cash by $150. And then on January the 5th again, they did another transaction that increase the cash balance. So what you're going to see is every time cash goes up, there'll be a debit in this ledger, and every time the cash goes down, there'll be a credit in this ledger. Another way of looking at the ledger is what we call a T account. Again, remember debits and credits, left side, right side? Each T account is a ledger. It represents that file folder for the account. On the left side of the T account are all the debits. In this case, because cash is an asset, anything on the left as a debit is increasing that asset. Anything on the right side of the T is decreasing the asset. And what you see there is the exact same depiction of the general ledger you saw a moment ago. And that, ladies and gentlemen, is transaction analysis and the very first step in our accounting cycle.